We did a small study over the last 15 years when Nifty PE was less than 20 through a disciplined approach, basically, which eliminates your behavioral biases. And therefore, you have what we have is a model-based asset allocation structure invested 1 crore 10 years back. Today, that value would have been around 3.2 crores.
Hello everyone. On behalf of Bajaj Finance Limited, I'd like to welcome you all for another exciting session. Today in this session, Mr. Farhad Gadiwala, who's currently working with UTI Mutual Fund as Executive Vice President and Head of Products, would be talking to us about the new NFO called UTI Balanced Advantage Fund. Uh, Sir, I'd like to welcome you to this session.
Thanks, Rohan.
Mr. Farhad as an experienced professional, having experience of over 20 years. He has worked in various asset management companies in India, of which nearly 16 years has been in developing and managing investment product across various asset classes. Today, in this session, Mr. Farhad will educate us about the new fund offer, UTI Balanced Advantage Fund. Balanced Advantage Fund is a very exciting category, which is very popular among many investors and offer a unique proposition to potential investors. Well, without wasting much of our time, I'd like to hand over the stage to Mr. Gadiwala, who will help us understand this new fund offer from UTI Mutual Fund in a better way. Sir, please, you can take it ahead from here.
Sure. Thanks, Rohan. I'll just share my screen. Hi, friends. Thank you for listening in to us. And I think we couldn't have had a better opportunity to present UTI Balanced Advantage Fund. If you have been an investor in the equity markets over the last 5, 10, 15, 20 years, you would have seen that, investing in equity markets is, not without the volatility that it accompanies. A lot of times, the market is known as the sentiment barometer of the economy. So it takes into account a lot of times the noise that is playing in and around. There are a lot of ups and downs. There are a lot of times where investors have seen their, investment value go down. Sometimes brief periods of time where money has not been made by investors. So you have seen all this, but if you look at the long-term picture, in the last 20 years, the market has delivered more than 17% CAGR on an annual basis. So that's the kind of the nature of the markets that are there. But if one were to move to the next slide, which talks to you about the underlying economy, which is your nominal GDP. The nominal GDP, which is there, the blue line here, tells you that it's pretty much flat and it's not as volatile as what the Nifty 50 returns are there in the orange line. So when the underlying, the economy where it's giving a robust output of around 12 to 13% on an annualized basis, you see the market going all around the place because that's because it factors in a lot of noise, and markets are therefore more volatile than the economic growth and the corporate earnings that one sees over a period of time. We know well that when it comes to investing, we always tell people that look at the fundamentals, come in when the valuations are low, and exit or stay put or bring your allocation down when the valuations are high. So we did a small study over the last 15 years when Nifty PE was less than 20. At that time, the cumulative monthly equity flows into the markets were close to 60,000 crores. That's just a shade above what today you will get into a monthly SIP flow that's happening. And if you look at the same time, when the PE was above 20, 10.7 lakh crores has come in. But look at the difference in the returns. When valuations are low, your the 1 year forward, 2 year forward earnings are pretty much high. And if you're investing at highs, your returns are not that commensurate. So what does that tell you? That we as investors are driven more by emotions. We get swayed by the noise that's there in the system. We take a lot of actions based on what's happening in the market in terms of if there's euphoria, there is fear. So when there is euphoria, you are greedy. When you're fearful, you want to cut down losses and move out. But that's the actual time when you should be topping up your investments. Let us see, next slide. This is a study done by none other than Morningstar. They do the study even in US, and last year they did the study. This study typically tells you that what is the investment returns versus what the investor can expect the returns. So if you look at the 10-year bars, you would see that the investment return has delivered a return of around close to 12.3%, while investor returns are 9.5. Again, that difference, that gap is due to the behavior that we see in human beings. We get swayed by the biases that are there naturally within. We are fearful when we should not be fearful, and we are greedy when we should. So that difference is around, if you see the returns is 2.8% on a 10-year basis. It does not look too much, but if you want to look at, in terms of value of investment, if you had invested 1 CR, 1 crore 10 years back, today that value would have been around 3.2 crores vis-a-vis what it is today, what it is potentially 2.5 crores. So today you can see that investors have a potential gap that is that that they are not the actual investment value is much higher than what the investment value for the investor is. So there is that potential gap. Now I'll move to the second. We are all aware that amongst the asset classes we have both equities as well as fixed income. We are well aware that equity in the long term is a wealth creator for us, but it comes with a lot of volatility. Similarly, while fixed income gives you reasonable returns, it comes with a sense of stability, that it brings to the portfolio. So when you combine both these asset classes, because these asset classes have low negative correlation, you will see that any combination of this in different proportions. Here we have taken three proportions just to highlight, to show you the effect of the combination, the impact of how better risk-adjusted return. So higher the equity component, higher is your return, but still higher is your volatility. So if you were to look here, when the equity portion is 90%, the returns still are significantly high, 15.9%, but so is your volatility. As you move down and come to the other extreme, which is where equity is 40% and fixed income is at 70%, you would typically see that returns have meaningfully what's come down meaningfully has been the volatility, that is your standard deviation, that's come down significantly. Therefore, asset allocation is very important while navigating market volatility, because a combination of equity and fixed incomes gives an investor better risk. Now, as a lay investor, if one were to see, there are challenges when it comes to doing asset allocation and rebalancing. If one were to look at it, doing yourselves, you'll have to construct the portfolio, manage the risk, plan for that review, look at the rebalancing, and manage your emotions at the same time. Plus, there is an incidence of tax that every time that you sell or increase, whenever you're selling your investments in either of the classes to change the asset allocation, there is a tax incidence that happens. So what do you want? You want a function that gives you a dynamic portfolio rebalancing through a disciplined approach, basically, which eliminates your behavioral biases, and therefore, you have what we have is a model-based asset allocation strategy, which is again, since it's happening in the same scheme, the same fund, it is far more tax efficient than doing it between multiple schemes of equity and fixed income. If I were to move to the next slide, so hi friends, this is where exactly UTI Balanced Advantage Fund comes into the picture. The fund offers basically three Ds. Your diversification, that's your primarily the combination of equity and fixed income asset classes, disciplined approach using a model guided approach to dynamically rebalance the portfolio. So if I have to just make a small this thing cursory, these are the three Ds that the fund offers. If we were to look at, from a diversification perspective, the net equity allocation from the equity perspective will be 30 to 90%, and on the fixed income side, it will be 10 to 35%. At any point of time, we will manage the gross equity exposure at 65% of the portfolio using arbitrage so that investors can benefit from the equity taxation. Now moving on to the heart of the product, which is where the asset allocation, comes into the picture, the model. So this model has four factors: two valuation-based factors, two yield-based factors. Uh, these factors are all fundamental in nature and are intuitive. You need to buy when the markets are cheap, and you will sell or decrease the equity allocation when the valuations are high. So you have two factors, which is your 1 year forward P ratio and trailing 12-month PB ratio. Both these factors are negatively correlated with the 1 year forward earnings. And if you were to look at the trailing 12-month dividend yield and the yield gap, which is nothing but the difference between the equity yield and the bond yield, these two factors are positively correlated to the 1 year forward returns. So what we did when we set out to undertake the building of this model, in fact, at that point of time, we looked at around 15, 20 factors, and we saw that these four factors, when they were combined, gave the best correlation to the 1 year forward return. And based on this, we have developed a dynamic asset allocation model, which gives you the net equity allocation at any point of time. So here you see the orange line graph, which tells you the net asset equity allocation for the fund, while the gray shaded portion is nothing but the Nifty 50 PRI movement. So typically, we all remember the COVID period vividly. So just before COVID happened in February of 2020, you saw that the net equity allocation the model threw in was close to around 55%, and it went all the way up to 87% in April of 20. And that was because in the month of March, the markets corrected by around 25%. So that's how dynamic the model is. To tell you a little bit more about the model, we look at reviewing the model on a weekly basis for rebalancing. Once you we check the difference between what the model output is and the current equity allocation. If the current equity allocation and the model allocation, the difference between them is plus or minus 7%, or that is outside that band, then we undertake the asset allocation. So let me give you an illustration. If at the end of June 2023, the net equity allocation was 62%, if the reading in my model the next week comes to around 65%, I will not undertake an asset allocation change. The reason is because it is within the tolerance band of plus or minus 7%. Now, what does plus or minus 7% mean is if the current equity allocation was 62%, That means I will undertake any asset allocation change if it is 62 plus 7% is above 69%, and below 55%, which is 62 minus 7%. So if it is outside these ranges, below 55% and above 69%, then we will undertake, the model will undertake the rebalancing. There will be no human intervention. My fund manager will not intervene in the asset allocation change if the model suggests so. Another question that might come in the mind of investors is why this 7% tolerance band? We tested this tolerance band over a period of, the last 11, 12 years, and we have seen this tolerance band was an optimal tolerance band, which gave you gave investors optimal returns, because if we decrease the tolerance bands to say, plus or minus 5% or 3%, the churn increase, and by the churn increasing, that is the portfolio churn increasing, the number of asset allocation changes increases, thereby it increased the cost, the impact cost, the transaction cost, thereby the investor got suboptimal returns. So in order uh, to have optimal returns for the end investor, we have kept this tolerance band of plus or minus 7%. Now, what's most important about this model is you would want the model to do well and capture the upside when the markets are high, and limit the downfall. This is exactly what the model does. On the upside, it captures 67% of the upside, and on the downside, it limits the downside by 49%. So let me tell you, elaborate a bit more on this. If you were to look from Jan 2012 to June of 23, what we did is we mapped every quarter with their forward returns at the end of each quarter. And we saw that whenever the markets were negative, during this period, there were 8 quarters which were negative. That's when Nifty 50 TRI gave negative returns. The model in all these cases did better, than the markets. Similarly, in flat markets, again, which was between 0 to 8%, it's when the model outperformed the underlying index, which was your Nifty 50. When we look at moderate returns from the markets, again, in this case, 6 out of 10 quarters, the model did better, fared well. It's only when the market is in a one-way run up direction, that's the time when we saw that the model played catch up. This is exactly what the model was outside to do. You wanted to protect the downside, which is what it did well in negative markets, in flat markets, and played, had a higher participation in the upside moment of the equity underlying index. So, if I were to break it, into segments, what is the source of alpha creation for the balanced advantage fund? Our balanced advantage funds derive its alpha from the asset allocation, which is model driven. And I have earlier also said that we will manage a gross equity exposure for 65% throughout, at gross levels. During the period of the existence fund. That is to give investors, the possibility of equity taxation as per the current prevailing laws. The next source of alpha creation comes in from sector selection and stock selection. Primarily, fixed income provides portfolio stability to this product. So at the end of the day, while both my equity as well as the fixed income part is actively managed, we expect the equity part to deliver the alpha. Manager is going to invest in you know, stocks which have a long runway for growth. Plus, he will not shy off away from taking, cyclical opportunities if they are present, or turnaround stories. So at the end of the day, the fund manager will use a blend style of investing, both growth as well as value, and will, as I said, the portfolio will have a large cap bias. When I say large cap bias, at any point of time, it will have 80-85% in large caps, because the fund manager would want to have the flexibility to move around, the asset allocation faster. So if there is a cut in asset allocation, he needs to have liquid stocks to, decreases, exposure. While similarly, if he's increasing this exposure, he needs to do the same thing there. So large cap stocks provide a lot, have higher liquidity. So that's where large cap stocks coming to the picture. Moving to the fixed income part, again, as I said earlier, the fixed income part gives you the stability that is required. So therefore, the focus is on quality and liquid issues. So when we say quality, we will be investing predominantly in sovereign and AAA rated issuers, and within that space also we will try and get in issuers which have higher liquidity. So again, here, the portfolio manager has the ability to move in out, cut the exposure or increase the exposure, easily. So that's what the active participation from both equity and fixed income will do. To summarize, when we started off, we looked at the behavioral gaps that as human beings we have. We are driven, more by sentiments, more by emotions. So we don't take correct steps towards bringing an optimal asset allocation. To bring about the asset allocation, we understand that, even if we were to overcome these human biases, the challenge remains in how well we are going to be able to rebalance the portfolio. So that's where UTI Balanced Advantage comes into the picture. It has a model-driven dynamic asset allocation, which dynamically allocates between fixed income and equities in a tax-efficient manner. So I would just like to end my conversation with you here, and I'll have the floor open for question and answers. Thank you.
Thank you so much, sir, for giving us complete insights into the new fund offer from UTI Mutual Fund. To begin with, we have few questions which are very common with our investors as well. The first question is, how is a balanced advantage fund as a category apt for new investors? If you could throw some light on the same.
As you said, our balanced advantage fund. This is one fund that we typically tell investors to come in with a lump sum amount, because it is here that there is an automatic asset allocation that is done, rebalancing done by the model, and then equity or and fixed income part is actively managed by the fund manager. So this is what happens, and therefore we advocate that if you are at any point of time having lump sum money, this is the fund to come to, because the asset allocation is undertaken by the fund as well as the active management of each individual asset class is done by us. So just to add to that, while I would have alluded in my presentation, this basically is just a model that's not backdated, but it is running live in our multi-asset fund since April of 2022. Pretty much that fund has been doing really well since April 22. So if one were to look at the returns, you will be able to see that it's doing pretty well amongst its peer group. So that's I would want to say that this is just not a model-based approach that we have just back tested it one fine day and come to you and coming up with an before, but this is something where we are going to come and deliver on something what we have already tested in the markets for the last 15 odd months.
Okay, sir. I have one more question, sir. People get confused, and it is very common. If you could throw some light to indicate the difference between a balanced fund and a balanced advantage fund. Uh,
Okay. So I would say a balanced advantage fund is nothing but you allocate the assets dynamically. It is dynamic asset allocation. There are variations of balance funds. You could have a static balance fund wherein you could have one asset allocation, one static asset allocation. Let's say equity is 65 and debt is 35. So that's one static allocation, and all incremental money that flows into will be in that proportion. But a truly balanced advantage fund is the dynamic asset allocation variety, where depending, like what we do in our fund, depending on the valuations, on the fundamental factors based on valuation, we try and increase our exposure when the equity markets valuations are cheap, and decrease our equity exposure when the valuations are at a high. So that's where the dynamism of the asset allocation model comes into the picture, and that's how different balanced advantage funds are.
very interesting question for you, and it will excite most of our investors. As markets are all time high, is it the right time to enter the market? So, what are your views on the same?
Index levels, market being all-time high, if you have been an investor maybe 5 years, 10 years, 15, 20 years, you would have seen multiple highs that have been happening. So these are index levels, these are price levels. Typically, what we look at is we look at buying when the valuations are cheaper and not entering when the valuations are expensive, so that's what we try and do, reduce our exposure when the valuations are high in the equity market. So let me give you an example. Today, Nifty would be close to around 19,700, 19,800. October, December of 2021, the Nifty was in the range of 18,500, 600. So maybe a growth of around 7%. But do you know the PE at that time was Nifty P was close to 28, and today it is close to 23. So while you today may say that at 19,700, 19,800, when your markets are creating all-time highs, but actually the valuation is relatively in the I wouldn't say cheaper valuations, but at the higher band of the fair valuation. So that's where we are seeing the markets. It's not downright as expensive as it was in October or December of 21, where we would have actually said, okay, we will be decreasing our equity exposure. Plus, the model throws up dynamically between the four factors. It throws up, dynamically the equity allocation. So we'll actually base our equity allocation on fundamentals rather than trying to take guess that okay, today we have reached all-time highs. When will we market fall down and let me enter, or try and do such things that we as human beings do. So this is more of a model-driven approach, and we will stick to the asset allocation. Even the fund manager will not have the liberty to change the asset allocation.
Okay, sir. Uh, Thank you so much, sir. I would like to wrap up the session now.
Sure.
Thank you so much, sir, for walking us through such an insightful session. We learned a lot about the new fund offered by UTI Mutual Fund. The fund name is UTI Balanced Advantage Fund. I hope our investors and potential investors explore this fund and enjoy the 3Ds offered by this fund. First D for diversification, which offers mix of equity and fixed income. Dynamic stands for the second D, where dynamic rebalancing of the portfolio happens, and it will be a disciplined approach where it will be a model guided approach. So I hope our investors definitely explore this fund and take due advice before investing in this fund, and look forward to create wealth for themselves in this dynamic market situation. Thank you everyone.
Thank you all, and looking forward to your participation in this NFO. Have a great day.
Yes, thank you, sir.